These days, there are few things more frightening than a European country trying to raise money, particularly when it's one of the world's biggest debt markets like Italy. Italy's hoping to raise a few billion euros overnight and then some more the following day, so people are a little edgy, to say the least. Here's an anxiety gauge. Italy's 10-year bond rate is virtually back at that 7% mark, the level that triggered bailouts for Greece, Ireland and Portugal. So the euro remains under pressure, but the Australian dollar is weaker against the other major currencies. That anxiety over Europe and weaker US house prices triggered a sell-off in some key commodities like copper and gold. And it all took its toll on Australian shares, but bear in mind trading's very thin this time of the year, so it doesn't take much to move the market. All the big banking and resource stocks, particularly gold, were down, and for what it's worth, which isn't much, ARC Exploration shares fell 10% to 0.9 of a cent on that tragic news surrounding its Indonesian project. Sure, Italy may be a fashion giant and make sexy cars, but we have a lower 10-year bond rate. At under 4%, our bond rate has never been lower. Concerned investors are pulling money out of Europe and putting it in Australia because of our AAA credit rating, our resources business and our China links. But bond yields are also considered a good leading indicator of economic performance, so falling rates could be signalling a much weaker economy ahead. And that's finance.